Well, in the last chapter, we discussed three types of cost behaviors. They are variable cost, fixed cost, and mixed cost, which consists of both variable and fixed. And in the last chapter, we also discussed how to use CVP analysis as a very important and useful business analysis tool. Well, in this chapter, we will focus on one type of costing, that is variable costing. This chapter is divided into two classes. In this class, I will discuss what is variable costing in further detail. In addition, we will see what is the difference between variable costing and traditional absorption costing. And also, I will discuss how to compute operating income using variable costing and absorption costing. Well, in the next class, on Wednesday, we will discuss how to use variable costing to make management decisions for both manufacturing and service companies. All right, let's get started. First of all, let's see what's the difference between variable costing and absorption costing. Up to this point, we have illustrated the use of absorption costing when determining cost of product. Well, absorption costing consider three parts. Again, absorption costing considers three parts. They are direct material cost, direct labor cost, and manufacturing overhead cost. Variable manufacturing overhead costs plus fixed manufacturing costs. These two parts consist of the product cost plus direct material and direct labor. Well, this approach is called absorption costing because the product absorb all of the manufacturing costs. They are, as you see, material, labor, and overhead. These costs are recorded first as assets in the inventory accounts. Later, when the product is sold, the costs are transferred to the expense account as COGS. Well, absorption costing is required by GAAP for financial statements issued to investors, creditors, and other external users. Well, the external financial statements use the traditional income statement format with a focus on gross profits. But in managerial accounting, as I said, the information provided are primarily used by the internal users. So for the internal users, they focus on variable costing. Let's see what's the difference. Variable costing is an alternative costing method that considers only variable manufacturing costs when determining the cost of products. Variable costing includes direct material cost, direct labor cost, and variable part of the manufacturing overhead cost as the product cost. Fixed manufacturing overhead costs are considered as period cost, and these parts are expensed in the period in which they were incurred, because these costs are incurred whether or not the company manufactures any goods. Variable costing cannot be used for external reporting, but it is useful for managers to plan, to direct, and to control, to make business decisions. The internal financial statements use the contribution margin income statement format with a focus on contribution margin. And as you have learned in the previous chapter, contribution margin is the difference between net sales revenue and variable cost. It is the amount first contributes to covering the fixed cost, and after the break-even point, then it is to provide operating income. So this slide summarizes the differences between absorption costing and variable costing. And as I said, for absorption costing, the cost of products absorbs all of the cost incurred, and it includes the fixed manufacturing cost. Well, but in variable costing, this part is considered as period cost. So the difference is highlighted in green in this slide. Well, to illustrate the difference between absorption costing and variable costing, let's look at this slide. And we will also use the Smart Touch Learning Company as an example. This slide summarizes the company's price and cost information based on 20 units produced. 2,000 units produced. 2,000 units. The units product cost using absorption costing will include all manufacturing costs. There are direct materials, which is 150, direct labor, which is $75, variable manufacturing overheads, which is $20 per tablet, plus the fixed costing, the fixed manufacturing overheads. Well, the fixed part is $11,000 per year. And in this case, we can see it is $55.50 in case of 2,000 units produced. That is $11,000 divided by 2,000 units. In addition, the unit product cost using variable costing will include only variable costing. They are direct materials, direct labor, and variable manufacturing overheads. And this calculation is summarized in this slide. Okay, as we can see, this part, the fixed part, is the difference. In absorption costing, this part is included. But in variable costing, this part is not. Well, this is the primary difference between these two costing methods, absorption costing and variable costing. So next, let's see. Let's see how to compute the operating income using variable costing and absorption costing. Now that you know how to calculate unit product cost using variable costing and absorption costing, let's look at the effects of two methods have on calculating operating income. Well, there are three different scenarios. The first scenario is units produced equal units sold. Second, units produced are more than units sold. And third, units produced are less than units sold. Well, and as you can see, the operating income is the same under both methods when units produced equal units sold. Well, before we go further in detail, this is the summary of calculating the operating income. Let's take a look. In absorption costing, we use sales less COGS. We get fixed manufacturing overhead. Oh, sorry. I mean, we get the gross profit, and we use gross profits less selling and administrative expenses. And well, this part this part includes variable selling and administrative expenses plus fixed selling and administrative expenses. We get the operating income. But under variable costing, we use sales revenue less only variable costs. We get the contribution margin. And in variable costing, as you can see, the fixed manufacturing overhead comes to this part. The fixed manufacturing overhead comes to this part as the fixed cost. So in contribution margin less fixed cost, which includes fixed manufacturing overhead and fixed selling and administrative expenses, we get the operating income, the final operating income. So generally speaking, in variable costing, we use sales revenue less variable cost less fixed cost. And finally, we get the operating income. So let's use a specific example to look at these three scenarios. The first scenario: units produced equal units sold, and we have three assumptions. First, there's no beginning finished goods inventory. Second, the number of units sold is 2,000, which is equal to the number of units produced, which is also 2,000. And lastly, we assume there's no ending finished goods inventory because all the units are sold. Okay, let's take a look. In absorption costing, we use net sales revenue, which is $1 million, $1 million minus COGS, where the cost of goods sold equals to 2,000 times $300 and half per unit. We get the gross profit. The gross profit continuously minus selling and administrative cost. Where the variable part is $62.50 per unit, and the fixed part, the fixed selling and administrative cost is $116,000. In total, the selling and administrative cost is $241,000. Well, in this way, we get the final operating income, which is $158,000. Well, in this scenario, the units sold equals units sold. It should be the same amount as the operating income calculated in variable costing. So now let's look at the case in the calculation in variable costing. Okay, let's look at the calculation in variable costing. We use same amount of net sales revenue, which is $1 million, which is calculated as 2,000 units times $500 per unit. We get $1 million. First, we use the sales revenue minus the variable cost part, which includes variable manufacturing cost plus variable sales and administrative cost. For manufacturing cost, it should be $245,000 per unit. For selling and administrative costs, it is $62.50 per unit times 2,000 units each, and sum up them together. Finally, we get the variable cost is $15,000. So we use 1 million minus this amount. We get the contribution margin, which is $385,000. And we use this amount minus fixed cost, where fixed cost includes two parts. First, fixed manufacturing cost, which is $111,000. In addition, we have a fixed selling and administrative cost, which is $116. In total, the fixed cost is $227,000. So we use contribution margin minus $227,000. We get operating income to be $158,000, which is the same amount of the operating income calculated using absorption costing. Well, this is the first scenario where units produced equal units sold. Well, again, in this scenario, the operating income using both methods should be same amount. But next, let's see the second scenario. The second scenario, units produced are more than units sold. So we have the following assumption. First, similarly, there's no beginning finished goods inventory. Second, the company produced 2,500 tablets, which is more than the tablet computers sold, 2,000. And finally, we have 500 units included in the ending finished goods inventory. So as you can see, the company produced more units than sold. Well, first of all, let me give you the brief conclusion. The conclusion is operating income under absorption costing is greater than under variable costing. So that is because the unit cost under absorption costing is greater than the unit cost calculated using variable costing. Well, because absorption costing includes the fixed manufacturing overhead per unit, whereas variable costing does not. So let's look at the calculation in detail. First of all, absorption costing. We use sales revenue, which is still $1 million, less COGS, which is the gross profits, and continuous it continuously minus the selling and the administrative cost, which includes two parts, variable and fixed selling and the administrative cost. In total, the selling and the administrative cost should be $241,000. So we use the gross profit minus selling and the administrative cost. We get the operating income. Additionally, we should have the ending finished goods inventory balance to be $144,000, $144,700, which is calculated as the per unit cost under absorption costing times the units left on balance, which is 500 units. But under variable costing, the unit cost is less than that in the absorption costing, therefore resulting to a greater operating income. Well, same amount of revenue, net sales revenue, but under variable costing, we first of all minus the variable costing, which is $615,000 in total. We get the contribution margin, $385, and we use the contribution margin less fixed cost, $227,000. We get the operating income, which is $158,000. Which is less than the operating income calculated using absorption costing. And for the ending balance in finished goods inventory account, it should be $112,500. And as you can see, the variable costing calculates the unit per unit cost using only three parts: variable direct material, variable direct labor, and variable manufacturing overhead. There's no fixed manufacturing overhead part in variable costing. So similarly, let's look at the third scenario. Let's assume there are 500 units in beginning finished goods inventory. The company produced 1,500 units, but sold 2,000 units. So for the ending finished goods inventory, there are 0 units. In conclusion, the operating income under absorption costing is less than under variable costing. And again, let's look at the per unit cost using these two different methods. Again, under absorption costing, the fixed manufacturing overhead is included, but this part It's not included in variable costing. So this is the calculation in detail. Same amount of sales revenue, $1 million. Under absorption costing, we use $1 million minus COGS. We get gross profit, $376,800. And we use this amount minus selling and administrative costs, which is $241,000. We get the operating income to be $135,800, which is less than the operating income on the variable costing, $158,000. So this slide summarizes the income statement for the 3 years, or for these 3 scenarios. In the 3 scenarios illustrated for Smart Touch Learning Company, the only difference was the number of tablets produced. In each year, the number of tablets sold, the sales price per unit, the variable costing per unit, and the total fixed cost were the same amounts. In this slide, operating income under absorption costing was greater than the operating income under variable costing in year 2, when production is more than sales, and vice versa in the 3rd year. In the 3rd year, the operating income under absorption costing is less than that in variable costing. So this is a pretty much short chapter. I used only less than 40 minutes to illustrate the learning objective 1 and the learning objective 2. So I believe that's all of this class. And in the next class, let's see how to use the variable costing to make management decisions for both manufacturing and service businesses. So thank you guys for your attendance. Please let me know if you have any questions, or I will see you on Wednesday. Thank you.
Thank you, Professor.